Welcome everybody to a VALUFIN webinar where we'll be looking at another element of our framework. Thank you very much for joining us. I'm Sharon Constançon. I'm Chief Executive of VALUFIN in the UK. As we've had the few elements beforehand, this is a series of webinars that make up the mnemonic VALUFIN because it just gives us a framework by which to work. Foreign exchange is something that is a complex environment. To say foreign exchange is easy is silly. It is a difficult environment because there are so many moving parts. And talking to that point, the things that we need to concern ourselves with, and we'll come back to these a couple of times through the session. Every business is unique. No training for even finance directors or people are given in any form of formal education. You will only pick it up as a direct plan to become educated in the space or through experience. Markets and environments around you are complex, and it is a very volatile market, foreign exchange being the largest, most liquid market in the world. And the problem that we're dealing with, that even when you think you understand what foreign exchange is about, we need to respect the fact that every business is unique, and therefore the Forex requirements are different. So looking at that in just a little bit more detail, the area that we're going to be covering today is about the business. It's about the uniqueness of the company, why that creates a challenge, and what those challenges are. So we'll be covering most of the points within that circle later. The mnemonic, that is purely there to create a framework. It's to help us remember and form a structure to make sure we go through all the foreign exchange elements. So if you were, as a finance director, wanting to understand what are the areas you should be looking at that are most likely to be the things where you need learning, you now have something to look at, whether you're looking at the value of Forex, assessing aspects of it, learning more about certain parts of the business, understanding the impact that importing and exporting have, finding the solutions to your foreign exchange situations, what you need to do internally, and how that new environment for you as a company puts you in a much stronger place. Today, we're going to be dealing with U for understand, and that is about understanding the business and making sure that all the elements and steps that we're going to cover today, you are respectful of, understand, and where possible, own the best solution and process possible. Looking at understanding, we start first of all by looking at imports and exports. I've created a little image which makes it easier for us to get through the different steps of what happens when trade occurs for a business. And we'll then go back to this model again, and we'll go through the various steps today. And shows that how it manifests within the business, but also the critical part is where we look at the different business activities, commissions, monthly accounts, all those things. We'll be a lot more wise when we get down in the next half an hour. So goods move. So we have import and exporting, goods that flow into us, goods that flow away from us, and these things might be services as well. We'll talk about that. Most of our freight and most of our goods move by air or by sea. We have our documents that flow. We're going to need to be concerned from a Forex element around the flow of funds, and locally around liquidity and those issues as well. That then integrates all this activity on the Forex side, integrates into the various parts of the business, whether it be the people, sales, production, manufacture, the customer, the staff. All of those elements are impacting, and that is all then collated, and we try and record it effectively within an accounting system. And I use the word try, and I use the word effectively for good reason. The last stage of the timeline is when you sell something to the customer that may or may not have a imported or exported element to it. So in this example, we might import certain stuff and put it into manufacture, and that then becomes a product that goes out to the customer. The result of all of that together is we have knowledge about our business, which is the uniqueness about this entity for which we're working and for which we're managing their foreign exchange. So our session today is to understand these different steps within a business environment. So understanding exports. A business exporting and importing starts right at the beginning, the business strategy of the organization. We might have a strategy that was purely local at the beginning of our business. It could have been importing or exporting right from the beginning. We may change our mind and do more importing and exporting during the life cycle of the company. And the reason companies will go through that process is it's a way to expand the business, reach greater markets, make greater returns, and make the business more sustainable. You're not going to do it if none of those outcomes are your expectation. And so making sure that when we trade internationally, we work out which currency we're going to trade in. So if you're working with a company in the US from the UK, both major currencies, there will be a debate as to whether you are trading in sterling or whether you're going to be trading in US dollars. And that becomes a negotiated situation. It's very business unique, and it's part of the whole engagement with the partner that you're working with, the customer that you're working with. These could be companies within your own group. It could be distribution centers. It could be the end consumer as well. But one thing I'd just like to identify is it's like two sides of the same coin. If you are dealing in your home currency, that is simpler for you, much, much easier in all respects. For the customer, they are now dealing in a foreign currency, but they're dealing in a foreign currency that is the supplier's home currency, therefore not at risk of having another accounting margin put into the price. So if you are buying, it's always nicer to buy in your customer or supplier's home currency. So if you're working in your supplier's home currency, they're unlikely to have this hidden margin for currency volatility. So we do encourage you not to insist on working in your home currency when you are importing or exporting, but to work in the supplier's home currency. So if we're looking at imports, from that perspective, imports, where do they go to? Why do we import? So we import usually to put something into a manufacturing process, to put into a production line, to just straight on sell, or to uplift, modify, change, and then sell. So the import is not for us invariably just to keep. Now and then it might be to import a piece of heavy equipment or some plant, in which case we're importing for own use. But trade in elements is usually for to go into something that we then are going to sell. So the risk factor here is quite different in terms of goods and money. If you're looking at the importing of goods, you have invariably protection around those goods going through the process of being shipped and arriving with you. And that's around all the customs, the duties, the bills of lading, the insurance, the letters of credit, all the different documentations, processes that you have to go through to get the goods from A to B. Where it becomes more difficult and where things like letters of credit, trade finance, and those kind of services come in from financial suppliers is where there isn't credit, isn't trust, is a new relationship, dealing with a difficult country where there isn't the liquidity. There are various ways in which the company can ensure when they've supplied the goods, they get the money in return. So that is always a complex area for the selling entity to get the money from the buying entity. Once we've decided we're going to import or export, we need to understand the flows. So first of all, goods will flow. So goods will flow if it's long distance, land or sea. Short distance, we might be air as well. Road, rail are different alternatives as well. And who knows, we'll add drones to that shortly, but we'll probably call that fly. Things like power, water, oil are on pipelines, but they still cross borders when this happens. And then the other one that we have are services. Services do not have any aspect of the physical trade complexities that exist, and services can be offered from a remote location, in other words, the supplier's source, or the supplier can move to the customer and deliver remotely or in-house to that environment. When we're looking at the flow of information and goods, we need to look at the point of risk transfer. At what point does the risk move from the supplier to the buyer? And that will be it can be at various times, at the time of agreement, at the time of goods leaving the manufacturing plant, at the time of bill of lading, in other words, lading of the ship, or at some point shortly thereafter when documentation flows, or it might be on docking at the destination. It might be on receipt of the goods in the warehouse of the customer. Usually anywhere in that timeline, your risk will transfer. That then requires insurance. It requires a recognition that the risk is now transferred. It is now your risk in every respect, equally to pay for it. You might have had a risk to pay for it even before that. So you then have costs like insurance, freight, harbor charge costs, airport costs, all sorts of weight costs, all sorts of things that come in over and above the fact that we'll have customs and duties if we have crossed a country, which is what we're talking about at the moment. The bill of lading being your key document that indicates that the goods have physically, what are the goods? What are they contained? And interestingly enough, just a couple of days ago, the UK government passed a new bill on electronic documentation, including the bill of lading. So bringing the new digitized future into trade, which at the moment is a very paper orientated, very manual orientated activity. The next thing we've got is the movement of funds. So funds flow in response to the goods. That can be according to various terms, anything from payment upfront, a deposit upfront, to everything later. And if everything is later, it could be at any points of that journey we talked about a moment ago that is agreed. There's one further one, is beyond the receipt of goods into the store, companies may be given credit. So they may have 30 days, 60 days, 90 days, 120 days credit, and they only pay for the goods at that much later period. So that can also occur. The other thing we need to look at when we're looking at movement of funds is physically how that happens. That is done by a bank, whether you have a broker, a platform, or any other form of supplier of services in front of that. Ultimately, a bank will process these funds between the initial bank that's doing the transfer, potentially an intermediary bank, and then the other party's bank. You get an intermediary bank when the two banks in question of the parties are not direct counterparties to each other. They find a common bank that is a counterparty to both of them, and that creates that extra leg in the movement of the funds and create a risk of delays in the process. Business impact is extremely important. Where does this impact the business? And I indicated in the diagram it's in multiple places. So if we look at it in two primary buckets, would be the financial bucket and the business bucket. So financially, it impacts liquidity, it impacts the cost of sales, all the various costs brought together come out against the cost of the goods. It will impact our profitability, it will impact our sustainability from a financial point of view, and it will impact our whole process of budgeting and forecasting. It will also impact things like incentive planning, incentive calculations will also be impacted. From a business point of view, we're looking at things like market share, the competitiveness of our product, promotions we might want to offer, incentives to our staff. And in the creation of the product, we're looking at the various steps of manufacture, turnaround, integrate to get the product to the state in which we're going to sell it to the customer. We're then going to look at understanding our accounting risks. This is probably the gray area, dark art of foreign exchange and of many aspects of finance and business, is trying to understand what the accounting system is doing to us and to our activities to ensure that at the end we are showing the right answer. Now, the way accounting systems work, they tend to revalue things and process month-end upgrades to values of our debtors and creditors in our books. Ultimately, the outcome should be identical. In reality, it's a noise and we can't see it. So we do say to companies, be very mindful of where you started with your costing, where you ended up with the actual value you paid for something, that all that noise in between is understood, absolutely, but we need to be able to report. And this is what VALUFIN does do for you, is ensuring that that noise becomes clarity, it becomes transparent, so that you know exactly where you first started with your costing and where you ended up paying, because that is true accounting still P&L at that point in time. So when you are creating something that you're using in manufacture, for example, the foreign exchange rate, the duties, the customs, the tariffs, and the bank charges, and the insurance, and the freight and forwarding, all of those costs are all added together. And those can cost a good, decent percentage cost, but they're usually known, understood, expected, can be planned for. The Forex element is the one that's the unknown. Yes, if you've got hedging, you do know what's coming, and you do know what price you're going to pay as a minimum. But from a Forex perspective, your risk is here. This is where you can lose up to something like 5%. I saw an example the other day where a fairly large item had been processed by the supplier directly through a payment platform. And the outcome was something like 8% is the margin that I saw on that specific payment. We saw, for example, a circumstance recently where a company didn't engage proactively with their bank in the negotiation of rates, and we saw 4%. So margins do exist from the banks. They are completely unacceptable at those levels and can be managed down to very acceptable levels. And what we find companies do is they try and rate jockey the market. I want the best rate now, and they're going to fight for 1 pip. The fact it's going to move 10 pips in the next 2 seconds, why am I fighting over 1? And if we look at a trend of a day, we can see easily 0.5% in a day's trade. That's absolutely normal. And yet we're going to fight over 0.05% on a rate, when actually, if we chose the time of the day, we would save far more money than the energy of having 3 people on 3 phones trying to phone 3 suppliers to get the best rate. That's used up far more money in the first place. There are providers in the various countries that will offer that rate jockey service, where they'll go around and look for the best rate for you. But I go back to the point, is managing your foreign exchange is managing it proactively. It's not fighting with the banks to ensure that they earn nothing and therefore don't treat you properly. So it's making sure that it's a fair relationship between the provider of your currency and yourself, and you'll make far more by timing than you will by fighting. So we make sure that we manage that relationship very effectively with the provider, respecting that they actually have to be sustainable as well. So understanding our accounting risks and the accounting element that we're looking at is, in the first case, the accounting system has the process at which it raises the invoice. That invoice can be raised in some companies. They will raise a purchase order in the accounting system. Very seldom, usually it's in an ordering system, but not in the main accounting system. At the point the invoice is raised, which can be anything between departing foreign country to arriving in your store, if it's an import example as given here, that invoice could be raised at any period over a 6 to 8 week period. Some companies actually work with nothing in their accounting system because they're on a cash, what they call a cash accounting basis, and will raise the invoice on the day they plan to pay it, so that they don't get variances, they don't get the noise. But it does, from an accounting perspective, offer you zero value-added information about where the business is at. So however much it might take away a complexity, it adds a fact that the company has to run everything in their heads. They've got to know how the business is doing in their heads. There is no data that's giving them any information. There's no ability to assess opportunity gained or lost. There's absolutely nothing by which we can benchmark ourselves other than to simplistically say we didn't make a Forex profit or loss. Don't think it's really achieving a good business outcome, which means the sooner you bring it into the accounting system, the sooner you can manage it. We know what we manage, we look after better if we're able to do that. But we do obviously encourage that from a Forex perspective, you begin that learning and engaging way earlier at the time of business strategy at the time of placing orders with your supplier or your customer on yourself, and making sure at all times you've got that. The next risk is the morphing that occurs on this item, sales order, purchase order, that exists in the system to the point it finally gets paid and we get to a financial year end, assuming it's afterwards. It might come in the middle to complex things further. Companies usually raise something at a costing rate. And we see a wide variety of choices that are made in this. For example, they might take the month-end rate displayed in a given newspaper on a given website at a given hour on a specific day, 2 o'clock a.m. in the morning after the close of the month end. Now, most companies do not get the interbank rate, which is available to organizations that trade interbank on values of $2 million as your denominator. And because you're invariably dealing less than that, you should not be entitled to that rate. And if the rate you're choosing is that interbank rate, you're putting yourself at a loss before you start. We also see companies starting with something that is completely irrelevant. And an example of that is the HMRC rate, for example. And that is the UK's tax authority's monthly rate. And it is a weighted average of goodness knows what, but it's over a wide window of time. So in theory, over a year, I think the logic is it would work out to being a less volatile rate, and it would be a weighted average of a year if you looked at it that way. The result is month on month, it is not relevant to the current market. So you might, for example, we had a circumstance the other day on the sterling dollar where a customer was raising an invoice at 118 and the sterling dollar is sitting up at 130 already. So it's not relevant. And therefore, you are creating this fog, this gray area and lack of transparency in your accounting system, because the risk is if you're going to price that into your production process and into the price to the customer, you're either going to overprice the customer or underprice the customer when these rates are not relevant. You can also look at costing, for example. One of the best costing rates to use is the weighted average rate of the cover you have on hand. That will be the least volatile and the most relevant. So we do encourage people to consider that as a costing rate instead, because you have hedged for the purpose of that trade. Use that hedge to cost the trade. Far more significant and valuable. Monthly revaluations occur at the end of every month. Companies then will restate whatever it was to the new whatever it is. So they will still use the same standard that they've used and chosen to use. They then revalue from last month's irrelevant rate to this month's irrelevant rate, creating an entry through to the income statement, which is classified as unrealized profit and loss, but it has a balance sheet and an income statement impact and creates noise. We then do revaluations at year end as well. Year end revaluation has a further complexity because it's not usually done on a monthly basis, is we revalue our hedging. And our hedging, because we've looked at a risk profile wider than the point we've raised invoices, the two don't match each other in value. And once again, we create a very high unrealized profit or loss by revaluing both the left and right of the equation because they're not the same. If you have hedged item for item, your invoice for invoice, the two will match because you'll have a profit on the one, a loss on the other, and a break-even net figure. But in the reality of business, that is nigh on impossible and will cost you a fortune to try and replicate. What we do at VALUFIN is we actually, through our mathematics on our own bespoke system, we calculate that for you so that you know what it is, but we cannot match that in business practice unless you do one transaction a year. It is not feasible. And then, so we have a lot of noise that's coming through our accounting system on a continuous basis. And people say, I've suddenly made a loss. I've made a huge profit and I don't understand it. The chances are it's an accounting anomaly, not a business profit and loss. In one of the earlier sessions, we covered what is business profit and loss. And business profit and loss is what I paid for the Forex item and what I sold it to the customer. That's business profit. In between is a lot of noise that we'll be seeing between costing rate and revaluation rates, and cash through the bank will be distorting that net answer that you can't find invariably in a business anymore, and you wonder why your net profit line is changing dramatically, and you've got no ability to get your hands on why. This is one of the main reasons why this happens. And we ensure for you that you actually have that understanding, that there isn't that cloud, and there's absolute clarity on all those stages and all those numbers that are creating noise in between. Out of all of this accounting process, business process, we need to sell a product, buy a product, make sure it is profitable for us to do either of those activities. So carrying forward the import example, we would now want to either export at this point or sell to a local customer, but we're in the selling phase, and therefore we need to determine at what price we're going to sell. Again, we come across business decisions here. Do we make a single price for a season? Do we make a single price for an order book or something that is a catalog, for example? Or do we price it bespoke for every item sold? Or is it just put out there into the retail market and we do what best we can? All different ways that we price. And in one business, you can have all of them. We might price our fixed equipment one way, we'll price our fast moving goods another, and we'll price our season fashion stuff in another way, for example. Sometimes, for example, fashion is a particularly good one to give it as an example on this one, is the time horizon. We have a massive time horizon between design and the customer wearing the item that we have manufactured. That can be an 18 to 24 month cycle of risk. So it's a very different element that has to, again, be managed. Product pricing technically is a process. We run the process through spreadsheets, through number crunching. It's a numeric step process we need to go through. But in reality, it's not. In reality, we have humans in the middle, and humans make a mess. They're confused. They have agendas. They are biased. They want certain things. Now, typically in the sales space, they want a sale. So you're now managing in the finance department the desire of a salesperson to ensure their incentives are going to kick in. And you've still got to manage and control the right pricing to the business, that you're still making the right business profit. And this tension exists between finance and sales continuously. It's complicated by the foreign exchange element. And we often see where organizations will, the salesperson would literally go off on their own, have a look at the markets, see that the markets have improved from 118, not even a few weeks ago, to 128 current kind of levels, and then say, well, actually at that rate, I can improve the price to the customer. I can give them a discount. They're going to now buy the product I want them to buy. So that rate volatility, if known to a shrewd salesperson, can allow them within their decision-making windows to actually create an environment where the sale is likely to happen. In all those cases, you must understand that the profitability of the business has been reduced. You've got a sale, so you've got certainty at a lower margin. And the impact this has on individuals' incentive is what is driving behavior that could be inappropriate for the business. It could be creating very large foreign exchange risks. So we always say be mindful of that, and making sure you don't get driven from a sales side. In one organization recently, we saw that the sales team would not inform the business of the sale they'd achieved until the absolute last minute for the production line. And invariably then it was still hidden from the finance department for months still to come, before the finance department even identified there was a large foreign exchange exposure. And the salesperson would then, now and then, as it suited the rates at the time, say, well, I need $1 million, I need $2 million. And the tie-up and the business knowledge and the control environment to look after something like that honestly was totally out of control. So those pieces of information should flow through the company, one, because of a production requirement, one, because of future budgeting and planning, one, to run the business effectively as a CEO. But then you have the whole finance element of the business that needs to run properly. And you can't do it when you've got a salesperson making decisions on whether they are going to tell the business about a contract they have committed the company to. And we do see that kind of thing happening. And it's quite amazing in today's day and age of control environments. So we welcome the innovation of digitalization on the blockchain, because that would make something like that a lot more difficult to achieve and put the company at risk. The last stage I want to just cover is knowledge. We have just gone through a time frame model of what is going to impact the business when they are trading internationally. And we have just touched on a couple of key areas. I've given you a couple of stories, but there's a lot more to it than what we have looked at. But this is the area where we urge finance directors, CEOs of businesses, to understand there's a chain of activity that's happening. And in every element of that chain, there is risk. And in most cases, if you're trading internationally, there's a Forex risk in most of those elements. So making sure that we, as finance people, look beyond the numbers, we look into the chain of activity within the business, and we integrate and infiltrate our influence and our control environments at all stages. Make sure you know about something right at the beginning. Make sure at the end you know what the business profit is and all the other things I've talked about in between, of which there's many. Forex is volatile. It is the most volatile component in your international trade. It's not the only cost, but it's the most volatile one of those costs. And people always say, well, if it's Forex, I can't control foreign exchange. I don't know what the rate's happening. As I said in the beginning, it is the largest, most liquid market in the world, and it responds to all sorts of data in all sorts of strange ways. It responds to volume, it responds to expectations, and it responds to facts, and it responds to geopolitical influences as well. And it also responds to rumors and rumors about things that may never, ever happen. So it's a very difficult one to predict. So why bother? You bother because as a business, you know what is best for you. And when the opportunity comes to secure the best for the company, you do it. And that is where you own the foreign exchange market in relevance to your business, and making sure you integrate, not in a panic stage when it's gone too far and you've done nothing, making sure that you're always mindful of your timeline, of your risks, of your volumes, and always take some form of hedging. Never 100% please, and never 0% please, because they're both just as risky as each other because the markets move. So here's our chain that we're going to be looking at, and we've covered it under the headings that are shown below. Just quickly to conclude, we are looking at, again, where does Forex management fit? It fits understanding the external market. It fits understanding the business's uniqueness. And that is the thing that we have covered today. It looks at the global influences, which we've covered in previous sessions. And it looks at making sure you understand the knowledge about your own environment. If you've got knowledge of your own environment, you can interpret the knowledge of the external noise, and you can work out what of that is for you. So if you look at the company uniqueness, what we have done is we've covered this area where we've understood our business, our supply chains, our customers, our pricing, our competitiveness, our cash flow, our liquidity, our credit, all of these things we've handled. But most importantly, we've also looked at the fact that it's the people in the equation that create more risk than anything else potentially in the business. Putting in dumbed down processes because you feel that gives you a security invariably creates more risk as well. Doing a review of an organization recently, and you looked at the way they were flowing processes by email, WhatsApp, your Teams chats, for example, and they'd created what they thought was a very deep control mechanism. All they'd created was people who did stuff without thinking. And the ability for fraud to exist in that environment was massive. And a particular equation that we were looking at once, if you'd looked at it, the way process works, senior executives, external people, a rogue individual can actually plug something into that process because people are not using their brains. And that's how things get laundered or corrupted or stolen, whatever it might be. Looking at your Forex instruments, you have a provider, bank, or an intermediary of some nature. A platform could be human, could be company, it could be electronic. Making sure we understand the different instruments that we can utilize, the timeframes in which we can place that hedging, making sure we respect and understand the play of interest rates and look at what we've seen on interest rates in the last few years. So if you look at 5 years ago and the 5 years to come, interest rates are a massive volatility that were considered a relatively stable fact before the pandemic. And then you've got the spot rate being the most volatile aspect. What we've looked here is the risk we get from our providers. Is our bank doing the right thing by us? Are they respecting us? Do we have good engagement? Do they listen? Can I get hold of them when I need to? Can I quickly trade if something is happening? Then we look at the risk from the markets themselves, the different rates we might be getting, the different constructs of our forwards, and how we're getting those put together. Has risk and cost been built into those, which very easily and very often does happen. Making sure that we understand the business and that we can correlate all the things we've learned today to this area of risk, and making sure that we are retaining and understanding and respecting our risk appetite, and that we do and make the right decisions within that. That is all, ladies and gentlemen. Thank you very much for joining me here today. It's been a pleasure to have had you share the time. We do potentially have 1 or 2 questions. I'm just having a look, if you could bear with me. We've got a question here on asking, for a finance director, how would you go about trying to understand this minefield? A very valid question, and it is an area to start the journey of saving anything up to 4% of your cost line, is to actually map out, taking the model that I've shared with you today, map out your supplies from China, from Japan, from the US, from Africa, from South America, bearing in mind that continents, for example, like Africa and South America, have a massive degree of complexity added into it because of the countries you're dealing with, and exchange controls and liquidity issues, credit issues, and fraud and corruption issues that can happen. Sorry, my apologies. Didn't realize that was still on. And by using the model, actually start to get an understanding of where those elements of the business are in different product lines, different suppliers, different services that you might get, and to what extent those contracts might have clauses in them that are costing you money. And with that, you can sit down and say, do you now need to look at how that plays out into the business? And the next session we'll be running will be a model on understanding how we now, with this information, interface into the market and the providers so that we can pick up that whole chain of risk and command. See if there are any other questions. But I think one of the most important things from my perspective is making sure that you, as the director of the company, absolutely understand the business, the effect of the business, and making sure that you can at all times know what's happening, respect what might happen if something moves in the markets very quickly, having at your fingertips the knowledge of where that will impact you. And things like, there's been a tsunami in Japan or off the China coast, or there's a typhoon or something somewhere, or there's a bad weather, immediately impacts shipping. What's that going to do? You've taken out foreign exchange expecting to pay for something on Friday. Now there's been a delay and you're not going to be paying for it on Friday. There might be a circumstance where you are exporting a commodity, let's say wheat out of Africa, or a consumable product, and now you've got disruption in your shipping environment. That's immediately going to define whether actually you're going to get the product or not, because it might disappear. It might go bad with all the weights that are happening in the stores or on the ships, or ships getting stuck in the Suez Canal. We know all these things happen. So it's making sure that all those external factors in the supply chain we've just looked at today, what are the risk factors of your shipping, freight and forwarding agents, looking at just in time, what does that do to your cost? So there's a lot of areas that you can be looking at constantly to refine, and not just do because that's just what we're doing. Rather, we're doing it in a structured manner to understand how that plays out as a bigger business issue, and therefore the impact that's going to have on the foreign exchange decisions that you're going to need to take. And we'll look at those in the following sections that are to follow. So I'd like to thank you very much for listening to this little soundbite on foreign exchange and understanding your risk in your supply chain, and making sure that you are able to now go and look into your business and say, how many of these components impact me? Some people think it doesn't impact them because it's only for a minute, it's a week, it's short, but those timeframes can equally be damaging. So once again, good luck with your foreign exchange review that you're going to do, and looking into the sessions, into the different sections of your activity. And I look forward to seeing you in the following 3 sessions, where we will take this knowledge and implement it in the business, so that by the end of this, we're going to say, I don't sit with the triangle of no training. I sit in that triangle with knowledge. So thank you very much to everybody. I appreciate your time and attendance.